So Avingtrans is effectively like a mini Melrose. We operate in highly regulated engineering markets, and our objective is to use a strategy we call PI, Pinpoint, Invest, Exit. And the idea is for us to buy assets cheaply, to improve them, and then to dispose of them at a value which is advantageous to shareholders later. We do that in one of two ways. We either work on buy and build type attributes, where we build around a core asset and add other acquisitions to it, or sometimes we just buy a single asset and improve it and eventually sell that again. This has been a pretty effective strategy over the last 10 years for Avingtrans, and we've returned a kind of compound annual growth rate of our share price of about 20% per annum. We're also a dividend paying stock, and we have a progressive dividend policy, but we're not a yield stock. And we're also keen on returning assets to shareholders in a tax efficient manner. As when we sold Sigma Aerospace, we had a tender buyback.
So the investment strategy of Avingtrans, PI, Pinpoint, Invest, Exit. Pinpoint, we tend to be looking at businesses over a long period of time. We have a lot that actually get onto the cutting room floor very quickly. But for example, the HT acquisition, we were following for over 8 years. And we're trying to look for distressed or problem child businesses where they're either unloved or they've got an issue, and as engineers we can solve that issue and turn it around. During the investment stage, it's not just putting in lots of capex. There's the investment in people, so the investment in the management team, in working with the Institute for Manufacturing, but also getting the apprentice schools. Start from the bottom. Apprentices are really important in engineering demographics. But also invest in turning around the supply chain, so actually sorting that out. And then on an exit, the first thing we look at is where is the exit with this acquisition? Who are we going to target to sell it in the longer term? And we're looking for 3 times typically our investment for our investors to make it worthwhile. And underlying, when will we exit? Well, we try to get the businesses to an adjusted EBITDA of over 15%.
In terms of market opportunities, we do like regulated markets, by which we mean things like nuclear energy in the energy market, medical markets, aerospace, defence, those sorts of markets. The reason we like those is that they have long-term characteristics, long-term contracting, the ability to stabilise businesses, even if they're underperforming. There's a relatively small supply chain, and it means that we can work with the customers to improve the performance of the business over a period of time. We then get into long-term contracts with those businesses, and that gives shareholders a lot of visibility of the pipeline of business over several years. And we have a number of contracts we've won in that regard, which we might talk about later. The other thing that we like in terms of those markets is that they tend to be concentrated in terms of supply chain. So that means that you're not constantly fighting against a lot of other potential suppliers. It's a much smaller supply set in typical terms. So when we're looking for M&A targets, we concentrate on those sorts of markets that have those characteristics. That can be anywhere geographically in the world. It doesn't matter to us in that sense, but we do concentrate on those sorts of markets. And as I say, when we're looking for M&A, we'll be stirring the pot on various targets over a number of years, potentially before we are able to pull off the M&A target.
Yeah, the performance over the last 12 months was a pretty good year, not a fantastic year. As most people know, we sold Peter Brotherhood for 4 times our gross investment. That put Avingtrans into net cash of over 20 million, allowing us to have the firepower to look for potentially new targets. We won some very large multi-year contracts with HS2 through our Booth subsidiary, and with Sellafield through our stainless metalcraft subsidiary. Both of these are, as I say, multi-years and give an annuity to our investors. And finally, we invested in a small part into magnetic resonance imaging, where we bought a majority stake in an Australian business with the idea to produce in the next few years an extremity magnet to supplement full body magnets.
Summarising returns to investors, over the last 10 years we've got a compound annual growth rate of the share price of around 20% per annum. Secondly, we've got a consistent progressive dividend policy, which has meant that we've returned to shareholders over £6 million in dividend payments in that time frame. And in addition, when we sold our aerospace business a few years ago, we were able to return over £19 million to shareholders. So in addition to the 20% CAGR of the share price, we've got £26 million returned to shareholders in a consistent and progressive fashion to make the returns to shareholders optimum over a long period of time. We see the outlook for us over the next 12 to 24 months as being very positive. There are still lots of opportunities for us to get into in terms of long-term contracting. And of course, governments around the world are planning to spend a lot of money on infrastructure, and that suits a lot of our markets and our businesses and our target markets and businesses. And in that regard, the pandemic may throw up opportunities for us. And of course, now that we're sitting in a net cash position, we're ideally placed to take advantage of any opportunities that might arise as far as M&A is concerned.